We've reached the 35th lesson in the course A Critical History of Economic Theory and Policy. In this lesson, we examine the reasons why the third way policies pursued by Tony Blair and New Labour in Britain and similar strategies in other countries faltered. Bringing together the different peoples of the European continent into an integrated economic union proved to be even more of a challenge than its most cynical critics had warned. Member countries were spending £140 billion a year on unemployment benefits for some 18 million people who could not find work. Political economists of the 18th and 19th centuries provided many clues regarding the policy changes needed to solve the problem of unemployment. Yet the political leaders and their economic advisors demonstrated they were ignorant of the insights of men such as Turgot, Adam Smith, or even John Stuart Mill. In The Losses of Nations, Fred Harrison restates the problem. Policymakers could not visualize a costless general solution such as the shift in the tax structure away from labor and capital and onto land. Britain's new leaders decided that the government must change the social welfare system to provide incentives for people to seek employment rather than rely on public benefits. Rising conservative influence over social welfare policies in the United States was providing the model for these reforms. The Chancellor of the Exchequer, Gordon Brown, realized that taxes on working people were already too high, but reducing taxes risks greater budget deficits. The short-term solution was to rely on revenues from the lottery to finance infrastructure projects. Fred Harrison describes who benefited most from these public investments. The government emphasized that these investments created jobs. Some new jobs were created, but the real winners were the people who owned land close to the locations where this money was invested. The value of their land rose. Nobody was looking, least of all the taxman. The Labour government had only one proposed answer to the nation's economic problems: invest in education and the skills required of a 21st century high-technology economy. Viewed from the outside by analysts at the World Bank, Britain was deemed to be in sound economic condition in 1997. However, a discussion paper released by the UK Treasury Department confirmed that analysts were unable, using existing models of the economy, to predict when the economy would turn upward or downward. Gordon Brown joined those economists who called for cuts in public spending and the continued movement in policy in the direction of market forces. A professor of social policy at the London School of Economics, David Piashard, forecasted in 1998 that at the end of the first 5 years of New Labour policies, there would be 2 million more British people fallen into poverty. And yet, in March of 1999, Tony Blair declared in an address, "Our historic aim will be for ours to be the first generation to end child poverty. It is a 20-year mission, but I believe it can be done." Beginning in 1998, changes were made in the Social Security benefit system to introduce tax credits. One reason for this change was to destigmatize these income supplement payments. A second objective was to link them to the nation's tax revenues, rewarding those who found work even if the income was insufficient to pull them out of poverty. As is the case worldwide, a major component of a household's cost of living is the cost of housing. And because the effective rate of taxation on the rental value of land is universally so low, land prices are high even in many depressed communities. Thus, one of the important shifts in policy that had an adverse effect on households in poverty was the reduction of housing subsidies. As rents increased, many households suffered the loss of minimal disposable income and had to seek other forms of public assistance. Britain was attracting some investments from other European countries where taxes and land prices were even higher. The completion of the Channel Tunnel and high-speed train service between Paris and London brought the two economies closer together and brought an increase in the value of land in those areas where the train stopped to take on or disembark passengers. Analysts and politicians promised significant economic benefits to people living along the southeastern coast of England, new employment opportunities, and rising property values. Of course, there was no announcement of any policies that would enable local communities to capture the increased land values, enabling them to invest in other forms of public goods and services. New Labour's next great policy mistake was to lower the tax rate on gains from the sale of assets, including financial assets, which are not really capital at all, as capital was defined by the political economists. What is almost universally true is that actual capital goods, for example machinery, buildings, computers, never appreciate in exchange value. Such goods begin to lose value almost from the moment of their first use. Some capital goods quickly lose value, not because of depreciation in their condition, but because they are quickly replaced by far more efficient capital tools. Economists in Britain failed to respond, to point out any need to distinguish between the taxation of real capital goods and the taxation of gains derived from speculation in the gambling casino called financial markets. At the time, economist Joseph Stiglitz resurrected the argument in favor of a tax on transactions as a means of reducing speculative trading and price volatility in asset markets. An earlier paper on the same subject by Swedish economist Peter Englund concluded that the tax on gains from the sale of property can exacerbate price dynamics by giving risk to lock-in effects, discouraging people from offering their property for sale, thus driving up prices due to an imbalance between sellers and buyers. In a paper titled Financial Deregulation in Sweden, Peter Englund concluded, the effects on risk-taking and intertemporal reallocation are welfare-enhancing. It is conceivable, however, that they are unimportant relative to the effects of tax arbitrage. Miller, 1988, has stressed tax considerations as a main driving force behind financial innovations. And Stiglitz, 1983, has shown that well-functioning capital markets make it possible to avoid paying taxes altogether by clever exploitation of asymmetries in the tax treatment of capital gains on long and short asset holdings. At a meeting of economists held in September of 1999 at the London School of Economics, participants attempted to reach consensus on the subject of corporate tax harmonization in Europe. The issues for members of the European Union were critical. The increasing integration of economic activity is placing greater pressures on these corporate income taxes, as the companies whose profits are being taxed operate increasingly across national borders, both within Europe and beyond. Tax differentials may also be assuming greater importance in company decision-making, as other differences between countries within the EU diminish, a trend highlighted by the adoption of a single currency within the Eurozone. The findings of this group substantiated the research published by Joseph Stiglitz. Stiglitz wrote, "A concern relates to the behavior of companies which can exploit differences between tax rules and tax rates in different countries to reduce their tax bills. Simple examples include the manipulation of transfer prices for transactions between affiliated companies, with the effect of shifting profits from high tax to low tax jurisdictions, and intra-group borrowing and lending, with the effect that interest payments are deducted against corporate tax at a high tax rate in one country and taxed at a lower rate when received in another country. What is missing from this debate is any attempt to distinguish between revenue earned by the sale of goods or delivery of services and revenue derived from special privileges, such as patents, special protections against imported goods, or specific exemption from taxes and/or regulations imposed on other individuals or entities. Examining the effects of measures put into place during the years of Tony Blair's administration, Fred Harrison concluded, taxes were increased, but the benefits were not shared out to close the gap between the rich and poor. The rich laugh all the way to their banks. As their homes escalate in value, they withdraw equity and splash out on the finer things in life. The high-achieving schools give their children the best start in life. This is reflected in the higher income earning capacity that these children will achieve, perpetuating the divide into the next generation. That is why people are willing to pay more for the locations in the catchment areas of good schools. Fred Harrison is not referring to the very rich here, many of whom own extensive estates and numerous investment properties from which they derive income from households who must rent apartments because they cannot meet the income and/or credit requirements to purchase a residential property by obtaining a mortgage loan. Property owners in Britain enjoyed a £352 billion unearned increase in value over the year 2003. Most of this increase came not from newly constructed buildings, but from the rise in land prices. Adair Turner, an executive with Merrill Lynch from 2000 to 2006, was appointed to head Britain's Financial Services Authority. He not only came out in support of the financial transactions tax scheme, but also argued for a return to the days when credit for the purchase of real estate required substantial cash down payments by purchasers. In September of 2009, he stated, "If increased capital requirements are insufficient, I am happy to consider taxes on financial transactions, Tobin taxes. Such taxes have long been the dream of development economists and those who care about climate change, a nice, sensible revenue source for funding global public goods." Economists continue to debate whether such a tax will be passed on to consumers in the form of higher prices. One very real concern is that a tax imposed based on the gross amount of a transaction, where profit margins are extremely narrow, would essentially kill certain types of financial transactions. Other behaviors are perversely affected by how real estate is taxed or not taxed. The very low effective rate of taxation of residential land parcels attracts speculators, even when there are few potential tenants who can afford to lease space in whatever building exists. Annual increases in market value more than make up for the absence of cash flow. New Labor's third way was not working out as well as hoped. In 2004, GNP per hour worked in Britain was lower than in France, Germany, Austria, Belgium, the Netherlands, and Norway. Note, however, that after 2004, the trend was once again upward. It then came to light that labor's leaders had kept down the statistics on unemployment by moving a large number of the unemployed to the list of people receiving disability benefits. This category of benefit recipients amounted to 7% of the workforce. And remember, this was the situation before the global crash of the financial markets. In 2005, there were nearly 700,000 vacant residential properties in England alone, 200,000 of which were located in London. Still, British voters decided to put their faith in Labour, which won the 2005 election. Challenged for leadership of New Labour in 2007, Tony Blair stepped down as Prime Minister and was succeeded by Gordon Brown. Brown would now have the challenge of pulling Britain out of its long and costly involvement in the Iraqi conflict and, soon, responding to the global financial and economic crash. By early 2008, the British financial system revealed the stress of involvement in global financial markets for derivatives, collateralized mortgage obligations, subprime mortgage loans, and other exotic financial contracts. The government announced the nationalization of Northern Rock Bank and the infusion of £50 billion. The financial crisis deepened by September of 2008, forcing Britain's Financial Services Authority to announce a ban on the short selling of bank shares. Investors began to move heavily into gold and other commodities as stock prices fell. In a speech at the United Nations, Gordon Brown called for changes in the rule of law that would bring an end to what he referred to as the age of irresponsibility and the era of deregulation orchestrated in the United States by the international bankers. Gordon Brown did his best to keep the British voters from remembering his 1997 pledge that Britain's property markets would never again experience skyrocketing price increases followed by a devastating crash. In the House of Commons on the 2nd of July 1997, he declared, "Volatility is damaging both to the housing market and to the economy as a whole. So stability will be central to our policy to help homeowners. We must be prepared to take the action necessary to secure it. I will not allow house prices to get out of control and put at risk the sustainability of the recovery." Had Gordon Brown studied political economy, he would have understood that to achieve stability in the housing sector, land markets must be tamed. And as writers going back to Adam Smith understood, the only way this can be achieved is to shift the source of public revenue from taxes on earned income, on the goods we produce, and on commerce to land rent in all its forms. Neither Gordon Brown nor Tony Blair would inform the public they had been warned of the coming crisis on numerous occasions by Fred Harrison, going back to 1997. To Gordon Brown, Fred wrote, "The bad news is this. Under existing strategies, there will be a mini-boom bust in the lifetime of this Parliament, followed by the cyclical big one after the next general election. Britain is preserving the features that nurture and drive the business cycle. There is nothing in the policies of New Labour that would obviate this outcome." Realizing that Blair and Brown, if they did anything, would refer his communications to subordinates in the government, Fred Harrison also wrote to Alistair Darling, Alistair Campbell, who had earlier expressed a willingness to receive input from Harrison on tax policy issues, and Peter Mandelson. On the 15th of May 2008, Mervyn King, Governor of the Bank of England, advised the British public of a decision that Fred Harrison concluded will go down in the annals of economic history as a catastrophe. King stated, "We are traveling along a bumpy road as the economy rebalances. Monetary policy cannot and should not try to prevent that adjustment. Inflation will return to the target and growth will eventually recover to a sustainable rate." A report issued in September of 2008 by the Bank of England confirmed what everyone now knew. The residential property markets were in free fall. Royal Bank of Scotland shares fell by a fifth, and the interbank lending rate skyrocketed as fear spread of widespread bank closures. At the same time as the major financial players were being bailed out, Gordon Brown orchestrated a change in the nation's income tax structure that increased the tax obligations on several million low-income households. The government also decided not to invoke a moratorium on foreclosures and evictions of households who defaulted on their mortgage loans. Residential property prices fell an average of 17% throughout Britain as more than 15,000 companies entered into bankruptcy during 2008. Gordon Brown decided to create an emergency committee to take charge of the government's response to the financial crisis. The deposit guarantee for British bank deposits was increased to £50,000 to slow the withdrawal of funds from banks. On the 8th of October, the Treasury announced a £500 billion rescue package for the nation's financial system. While stock prices rebounded in response, companies continued to cut payrolls. Official unemployment climbed to nearly 6%. Workers in many countries agreed to large cuts in wages to avoid job losses. At the end of October, Monetary Policy Committee member David Blanchflower said the Bank of England failed to respond to the warning signs of a looming recession and wrongly delayed cutting interest rates. By the end of 2008, Gordon Brown was forced to tell the public that the economy had ceased to grow. The illusion of responding to public concerns came in the form of a temporary reduction in the value-added tax. Lower-income households were to receive tax relief, and other measures were announced to support small businesses. Still, nothing was done to deter the large financial institutions from what critics called playing the system to minimize tax obligations. A bank analyst reported that the banks were borrowing large amounts of money on the markets in Britain in order to benefit from tax relief on interest payments. They were then using this money to run non-UK parts of their operations, and therefore minimizing their UK tax bill compared to the scale of their British operations. The banks responded that they were in full conformance with British law. Barclays also noted that the £1 billion paid in the UK was fourth highest among the UK's top 100 companies. Fred Harrison's warnings had been ignored. British experts and political leaders demonstrated they had a very flawed understanding of the main drivers of the business cycle or how to manage the economy toward stability. Typical was this statement received by Fred Harrison from Alastair Campbell early in 2003. "I'm a little bemused as to why you believe this country's economic policy is a shambles. These are difficult times for the global economy, but pretty well every independent expert believes this country is in better shape to weather these storms than our competitors. That's surely in large part a result of the economic policies followed by this government." The closest thing I could find as an acknowledgement that he was quite naive in his response to Fred Harrison comes from a 11 November 2010 blog by Campbell following his participation in a conference on Britain's housing crisis. There he states, "Part of the challenge for housing organizations is certainly to get their issue higher up the political and profile ladder. and one way might be to build on that insight and try to build a case more widely that whilst our home may be our castle, it does not stand in isolation, and the housing of others is an issue that affects us all. Even as property values were falling across the British Isles by the end of 2008, the website of the British government's valuation office continued to forecast that land values would continue an upward climb at least to 2012. Britain's financial sector was severely damaged by its investment in subprime mortgage loans originated in the United States. One bank, HSBC, was forced to write down £8.7 billion in defaulted loans, mostly from the U.S. subprime business. The total write-offs by all British banks in 2007 surpassed £12 billion. Even 4 years later, mainstream analysts failed to identify speculation in land markets as the driving force behind the collapse of financial institutions. As one example, in June of 2012, Onog MacDonald, a former Labour MP, a director of the UK Financial Services Authority, and a member of the International Monetary Fund's expert roster, wrote this. For the UK, the damage was done when banks bought mortgage-backed securities, credit default swaps, and collateralized debt obligations backed by mortgages of dubious quality, but which were at the time given AAA ratings by the rating agencies. The ratings were taken for granted until falling house prices, higher interest rates, and increasing numbers of foreclosures exposed the real extent of the risks. Banks were unwilling to lend to each other, not only in the U.S., but throughout the world. That was the beginning of the financial crisis from which we all continue to suffer. By 2010, the mood of British voters had changed. Few were optimistic, and their frustration was exercised in the election. A conservative Liberal Democrat coalition government was formed. In May of 2010, Anthony Giddens, former director of the London School of Economics, wrote in the New Statesman, "Even sympathetic observers argue that little of substance has been achieved. For the more determined critics, labor in power, labor as new labor, has been more than a disappointment. It has been a disaster." The party led an onslaught on civil liberties, betrayed leftist ideals, failed to make any impact on inequality, and, worst of all, embarked upon a calamitous war in Iraq. New Labour had promised a new dawn, and many feel betrayed. David Cameron became the Prime Minister and Nick Clegg the Deputy Prime Minister of a cabinet that contained 18 Conservative ministers and 5 Liberal Democrat ministers. As the new government discussed the policy options its leaders convinced themselves were necessary and in the long run would put the nation on a path to non-inflationary growth, near the end of 2010, Fred Harrison could only exclaim in frustration, "Gordon Brown was the key architect of Britain's collapse into the Depression of 2010. True, the UK was programmed into the boom-bust cycle before he became head of the Treasury, but he could have reformed the tax regime to prevent the country being sucked into the financial vortex. He failed abjectly."